Introducing our new series of intimate in-person trading conferences in some of the greatest cities in America. It's Market Rebellion Live. Next up, this June in Sonoma County, California. Savor some of the finest wines in America while you level up your trading with Pete Najarian, John Najarian, AJ Monty, Ryan Mastro, and Bill Johnson. Sonoma is limited to just 25 seats to ensure every guest gets personal attention, so act now. Tickets are going fast.
Hey, good afternoon once again, Market Rebels, and to all of our YouTubers out there. Stu, another big day on Wall Street. Dow was down about 200 points, Tesla down 11%. And it just shows we get so much volatility in the markets. But that's what we want to show you here on Coach's Corner, a different perspective from professional traders and market makers to help you make better decisions. But today, Stu, we have a super special guest with us. We have Anthony, we love it when we have special guests. Anthony Loiacono, who is a managing director at Corpay. You can find the website there at corpay.com. He was part of FleetCor, which is actually, or this company is part of FleetCor, which is a publicly traded company under ticker FLT. Former managing director and co-founder at Global Exchange Payment Solutions, which are they really offer expert solutions for high-risk merchants. And they process, now get this, about 1.6 billion with a B in transactions in 145 currencies to 200 plus countries. So if you want to know somebody who knows currencies, Anthony's your guy. So Anthony, thanks so much for being here and helping us out today.
Yeah.
Thanks, Bill.
Thanks for coming.
All right. Very cool. So as always, we like to do this little segment at the beginning called Chalk Talk, which is a little coach's huddle. And this is really for our viewers out there. Kind of gives them incentive to stick around. But let's say that we have Apple has operations in Japan. Which of the following quotes would benefit Apple? So when Apple starts the venture over here, the quote is US dollar, Japanese yen equals 135. And the question is, would Apple rather see it go to 125 or to 145? And if you don't know, this is why you have to understand this, even as traders, because as we talk about, by the way, we're going to answer that for you at the end for anybody who might be new. But as we like to talk about, there are hidden risks of currencies. And currencies play a major part. I mean, that's really what companies are trying to do. They're trying to generate cash flows, but they have to buy and sell currencies if they're doing business overseas. So, Stu, one of our favorite quotes from Carl Richards, risk is what's left over when you think you've thought of everything.
Yeah,
and I love this, especially
can't think of everything.
But people do. They say, "Oh, I've looked at my technicals. I've researched the company. They've got great cash flows, whatever." Okay, well, that's 4 or 5 things out of about 1 million things that you need to consider. You can't think of everything. But something that I think every trader misses is currency risk. It's something we just don't think about.
So that's when you're looking for $2 million to come over from China, but you only get a check for 1.8. Is that currency risk?
That would be currency risk. And it happens all the time. And as we're going to find out, to some very large degrees. So that's what we're going to talk about.
If you don't know that risk is there, you have a problem on your bottom line.
Yeah, you need to, at least, if you get nothing else from this presentation, you need to understand that it's there. We're going to show you some sources of how to find out and just how bad it can get. And just kind of open up the conversation to that. So even if you don't trade currencies, it's okay. And I know we do have a lot of currency traders and options on currencies, a lot of our Forex traders, but even if you don't, it affects you. Even if you're just holding shares of stock, you need to be aware of this risk. And is your company exposed to this risk? It's another big risk of holding an individual company over a basket such as SPY or QQQ. So we're going to get into some good conversations here. But as always, for anybody who's brand new, please check out marketrebellion.com/get started. Lots of free information, great videos to help you get started with your options trading career. So, Anthony, again, thanks so much for helping us out. very few people with your expertise in currencies. Could you start out maybe just with a little background, give us a little more detail about what your business does?
Sure. Thanks, guys. Thanks, Bill.
Of course.
Generally, we're an international payment solutions business. So what that means is we do business to business global payments. So our clients consist of major law firms to companies who have a need to remit funds from one currency, i.e. US dollars, to another currency, i.e. euro, for example.
I see.
We're a full service payment offering. So what that means in our world is we help them facilitate what we call the accounts payable process, which is typically, part of the treasury group in any organization, in order to facilitate payments in a variety of currencies. We can remit payment in pretty much every currency, less some of the sanctioned countries, obviously, the Syrias of the world and things on that level. But for the most part, our process is an automated process. So we process directly from what we call foreign invoices. So we'll receive foreign invoices. We'll extract all that information that's pertinent to the disbursement on the treasury side of the equation within the business. But what we're also doing is we're micro hedging, or we're hedging all those future payments, ultimate future payments into their treasury system. So it's fully hedged. So what they hedge today, if they pay off on that in a month or 2 months, it reconciles exactly to the penny.
Wow.
So hedging is part of our strategy.
So does that mean that if a company is invoicing today, they may not get paid that same amount of money a month or 2 months from now?
Yeah. So typically a company, say a company's in, London, will send an invoice for, say, services or a product or whatever to a company that's, say, sitting here in Philadelphia, for example, and they have to make the payment in sterling. Typically, they can make it immediately as what we call a spot transaction.
Right.
But oftentimes they'll hedge that. They'll, could potentially pay over, in terms, pay, say monthly over a 6-month period. They may have a discounted rate of paid in 90 days. There's a multitude of things that apply. In my world, we hedge everything out 6 months because it gives our clients the ability to capture that. It's not a currency, but it's the equivalent of what they'll ultimately pay in that currency without having to make an adjustment when they make the payment, 4 months from now, for example. The problem is if they have to make the adjustment when they make the payment, there's usually a gain and loss in their profit and loss statement,
I see.
which severely impacts their bottom line. If you're
and that's not what their business is, right? They're not looking for that. That's not what their business is.
No. Yeah. We say this all the time. We give you the ability to really focus on running your business because currency is not the market where you think you're going to, capitalize on or
right.
Make money. There's not a business out there that has a currency line item in its profit and loss statement as
right.
as a profit center. It just doesn't exist.
Right.
So it's usually against, it's on the expense side of the equation because it's either, plus or minus depending on currency fluctuation.
Yep.
Which is why they hedge.
Right.
There are tools in everyone's bag in the foreign exchange market. The biggest tool that's used within every business and every entity is a forward contract. It's really a hedge. So
yeah. So one of the things that we tell our traders is that there are certain risks that you have to take or that you have to accept. If you try to eliminate them all, you're just dealing with treasury bills, and there's an easier way to trade that.
Correct.
But there are some risks that you don't want. And this is where Stu and I think a lot of our traders kind of miss the whole connection of saying, which risks are you willing to take? Then let's take those and let's ship off the other, so to speak, to people who are willing to accept those for us. But we hear a lot where people will say, some of our traders, oh, I like this stock. I'm willing to hold the downside. And they say, let's go buy puts at the money, trying to do a full hedge. You're going, that's the risk that you were trying to take.
Correct.
And in businesses, Apple's willing to take supply demand risk, but they're probably not willing to take currency risk. And I think that's why a lot of people come to you. It's just unless they're currency traders, they don't want it.
Yeah, most people are not. I mean, in my experience, and I've been in foreign exchange since 1998. I mean, I'm sorry,
Wow.
1988, excuse me.
Wow.
So generally, 99.9% of, my dealings with my clients and our clients as a business and as we built our business was, there was very, people wanted to not so much as address risk. They wanted to address the strategy around risk. So they wanted to mitigate the risk as much as possible.
Exactly.
And that's part of the strategies that we built when we built our solution. We started the business in 1994, and we were, what we call a one-off currency dealer. So companies would call us to do their singular payments, things on that level.
I see.
But we've grown to become more of a payment solution, where part of our process is integrating risk through hedging solutions that are integrated in their experience. So what that does is it takes it takes the conversation around currencies offline, because we're then we become selling a service to something that is actually valuable to any of our clients, as opposed to one-off relationship where we always say that it's a race to the bottom. It's a race to the currency bottom. So
Yep.
By integrating risk strategy in our solution gives our clients the ability to really take that off of their plate and not worry about it. So, and
Yep.
That's why we've been so
exactly
successful.
what we teach to.
Yeah.
Now, you mentioned you do it for businesses. Would you do it for an individual?
No, not in our world. We don't do that.
I see.
It's not part of what we offer. We can't onboard an individual who's
I see.
wants to trade currency as on a day-to-day basis. It's just
Now, are these big companies? Would you do it for an Apple or a big publicly traded company? Or are they more smaller firms?
Absolutely. There's a variety of businesses who use us. We serve major law firms around the globe, so probably
Gotcha.
Probably our share within law firms who need this service. And again, it's basically you need to send funds globally, so you can be a small mom and pop to a Fortune 500. It's really irrelevant, but again, you're still
Same
using
game.
the same rails, you're using the same tools, and it's the same process.
I find this so fascinating because, again, it's one of those corners of the world, the financial markets, that people just never think about, that it's a highly specialized niche, and yet it's so important. So we came up with a little example here. So let's say that we have Dewey Cheatham and Howe, our favorite law firm in Delray Beach, Florida. Let's say they got to pay a $10 million settlement in Japan. They come to you, and the quote right now is 135 US dollar.
Dewey,
Japanese yen is 135.
Right.
What do you do? I mean, do you go out into the futures markets? Are these forward? I mean, how would you hedge that? How do you go about it?
Yeah, so it depends. So this is a $10 million settlement. Let's just say it's 10 million yen to make it easy.
Okay.
That converts into around $74,000 in US. So, the question is, do they have to settle today, or do they have to settle over a period of time?
Right.
Do they have to wait to receive funds in before they pay a settlement? There's a variety of things. If they're doing it just as an immediate payment, then they'll need to do it today. But, what they're not going to do is say, hey, I really think, yen's going to, go up to 147, for example, like it's trading today, right?
Yeah.
That's not part of their equation. They're not sitting there speculating on where they think, dollar yen's going to go. They're basically saying, hey, how do we get this off our books and settle it? I mean, that's the standard kind of mentality. It's not a question of, hey, I'm going to sit there and speculate, or I'm going to sit there and think that the dollar's going here, or think that's because it's 9 times out of 10, you're going to be off. There's no question. The currency
for sure
market is so big. It's the biggest market on a day-to-day basis and around the globe. I mean, it's trading constantly.
Trillions. It's crazy. Yeah. But would you do a forward contract with a bank? Exactly. I mean, how would you go about doing this? How would you set that up?
So basically, in this example, and let's just take an example, it's 10 million yen, and they need to move this yen in a month, for example.
Okay.
So you know what? We need to move, or let's say, we need to move this by September 1st, at the end of the quarter. So generally we'll hedge that out. We'll guarantee that rate based on our hedging strategy and say, okay, fine. It's, 10 million yen. It's say 74,000 US, for example. We make our money through a very narrow spread schema. So generally we'll just mark up, very, very thin margin to account for currency risk between now and when they're settling. So there are two types of processes when it comes to a forward contract. They can give us a date and say, hey, Anthony, we want to, we're going to execute this transaction on September 1. So typically the exchange rate's just a little better than if it's called a window forward. What they can do is draw down between now and September 1 against that 10 million yen. And
I see.
In increments. So they can take 1 million yen a month, for example, over a 10-month period. That's the preferred strategy when it comes to really executing a forward, because it gives you the flexibility to basically, kind of, if you have extra, your cash flow is improved, you can execute at a point in time. You can do a little bit at a time. There's no penalty for that. It still aggregates into a wire transfer and it's sent to whoever you need to wire to in a swift wire transfer.
Anthony, who's the counterparty? Who's the other side of this trade?
Yeah. Who's the other side of the trade typically is our bank partners. So we deal with many banks who, we have rate feeds coming in, and in our world, we use a preferred bank. It's like BOFA. So basically it's, we have Citi as well, and among Barclays, and, there's a bunch of different banks. And, the one thing we're not doing is comparing them. Hey, this is BOFA versus Citi. It just doesn't work that way in our world. We have a secure relationship with them. We get an exact rate feed. We have a currency commitment from them and a rate agreement. And, it's very tried and true, because then that reflects upon our activities. So we're not sitting there playing the rate game. We're basically offering a service with a high level of integrity and security as well.
Gotcha. So you've got feeds coming in. You don't have to pick up the phone and find out these
it's not the way it works in our world. No, it's
your
all
client.
automated. Yep.
Go ahead.
Sorry, so I'm sorry.
Your client is not looking to participate in the currency fluctuation. That's why he comes to you.
Correct.
And you create this contract so your client doesn't have to participate. That means that your client and you have separated out what risks you're willing to take and taken those out of the equation, and whatever is remaining is what they're willing to take. And that's a process that each and every client, including yourself, as you go ahead and execute this, takes part in, right?
Absolutely.
And that's part of the trading process.
That's absolutely part. That's the exact part of the trading process. We're still assuming risk because the client didn't settle. So we have mark-to-market risk. So our risk is associated with the fact that if the client doesn't execute, say in September 1, then we're sitting with this currency that we've, in theory, have locked in. Now we have to sell it back. And typically in foreign exchange, it's like a 20% window that we kind of use as our barometer for risk against whatever valuation we have in open contracts, in unexecuted contracts. So at any point in time, we have thousands of unexecuted, theoretical contracts out there.
Interesting.
In a variety of currencies, but it's still, let's say Dewey, Cheatham, and Howe from Delray Beach goes bust between now and when we expect them to settle, right? So
gotcha.
So, the one good thing is that we can always sell currency back because there's always a market.
Just might not be at favorable rates.
It just, exactly. It could, we're going to take a hit because we're going to take a hit unless the market, unless the dollar strengthened or weakened against, whatever currency we has.
Right. So you're willing to take the currency risk. They're not. And that's really one of the points that Stu and I wanted to show. It's exactly the same thing at your level of this business with kind of behind the scenes currency transactions as it is for our traders. You have to separate out which risks you're willing to take and then take them.
Correct.
and then hedge off the rest. But we find so many traders that say, oh, I'm willing to take this. And then they spend all their time trying to hedge the very thing that they say that they're going to take.
Yeah, exactly. Now, I mean, in our world, we vet the client before we onboard them.
Oh, you do? Okay.
Yeah. So it's part of our onboarding process.
Makes sense.
To validate that they're in fact, an entity who, in some cases, if they're large, then we'll ask for financials, things on that level that, is critical to our solution. In some examples too, typically banks will take a percentage of the forward deal that they're doing too. Sure. It's like 10%, and they'll hold that in escrow. And on my side of the equation, we don't do that. It's not part of our solution.
I see.
So because we'd always ask for it would be a daily, it'd be a daily adjustment. It would just be a nightmare.
Like a mark to market. Yeah.
Exactly. So again, it's not what we offer. But some financial institutions do. So
now, just out of curiosity, what I'm sure there's a wide range of things, but what are some of the ranges? Would somebody be looking to hedge something a year out, or is it typically 2 or 3 months out, or 5 years out? What are some of the ranges that you're working with?
Yeah, I mean, that's a good question, Bill, because it depends on their business. So what's really important to understand is that these clients of ours are running their business, and we're also recommending, we're suggesting, hey, I think you should tighten up your window, because the tighter the window, the better the exchange rate is. The further you go out, it just gets less preferred. There's a calculation, there's an interest rate factor that determines a forward contract. So the further you go out, the factor just adjusts only because you're guaranteeing a rate today for an execution date that could be 12 months from now.
More risk. Just like in the options
too,
right? Longer dated costs you more.
Yeah.
Costs you more. More time is risk.
We'll look at that with our client and make suggestions. Look at their window, what we call their settlement window, the day that they lock in versus the day that they execute. If we see that we booked in a forward, but they're pushing that limit at 6 months, we're going to suggest that they extend that window another month or two.
Interesting. So you're not just saying we're going to take this receipt and you just tell us what to do. You're going to actually develop a strategy or a plan against it as well.
Correct.
Interesting.
Which is something that a lot of our people don't do, Bill, right? They don't have a plan. They don't have a strategy.
Zero.
They don't create a plan to trade. And they don't plan to trade a strategy.
Other than I want to make a lot of money. That's not a plan.
Yeah, that's
not a plan.
It's not a good one anyway.
Yeah.
Let's take a look at
we all want to do that.
Why people would hedge. I pulled up just a few currency quotes here from Thinkorswim. So here's the US dollar, Japanese yen. Over, looks like maybe about a 6-month window, down 11%. People don't realize currencies can go through some very wild fluctuations. US dollar, Swiss franc, down about the same, down about 12%. US dollar, Canadian dollar, up 14%. Yeah. So they can be even more volatile than stocks. But most of the fluctuations in the big picture of things are the differentials in the inflation rates. But could you name some other things, Anthony? What are some other reasons for seeing, especially very sudden currency fluctuations? What are some of the risks that people are unaware of?
Yeah, I mean, think of, the currency market's so large and it's so varied because it's based on the biggest factor that really moves currency is interest rates.
Yep.
Country interest rates. So, treasury rates within any country, and that really pegs a lot of movement between currencies.
Sure.
But besides that, you have many other factors, political, economic. There's a host of reasons why. You look at, it's just there's just so many different factors that influence
flight to quality. Yeah, we've seen that before.
Yeah, and you have your majors. So you have euro, you have sterling, you have CAD, yen, they're relatively static, but at the same time, there's market movement within those currencies. I can tell you euro, for example, this time last year was parity. It was 1 for 1, and now it's trading in around 109.
Wow.
So, the dollar weakened against, it's 10%, delta between March last year, this time last year, and now, which, You know, if you want to travel to Europe, it's going to cost you 10% more this year than last year, as an example.
Yep.
So,
and that could be a big piece of change to a company that's doing a lot of
millions. For sure.
Yeah, exactly.
I mean, even when we look at some of the earnings reports too, when they come in and they'll say that they were expecting $1 per share and they come in at 99 cents per share, and everybody freaks and go, oh my gosh, they missed earnings. Well, it was a tiny percentage, and yet we can see 10% movements in currencies, 15% movements that could radically change their earnings, and people have no idea that this is going on behind the scenes. So we're going to show you some things that you can look at and some other examples. As always, little plug here real quick for anybody who's new, marketrebellion.com/get started. Lots of great information and free videos to help you get started. So here's some headlines that we dug up to show people just how bad it can get. This is from 2022. Wild currency swings take 34 billion bite from U.S. company profits. We had Domino's, Pepsi were already warning of foreign exchange impacts to worsen. I mean, so that we're not talking small change here. I mean, this is 34 billion. Here's a chart of it. Look at that. It's a massive thing for the second quarter of 2022. People have no idea. They don't realize just how big this stuff can get. So currencies, currency risk affects everybody.
You gotta, that trickles down, right? That trickles down into people's own companies, people's pay pockets, and something people need to be aware of when they're trying to evaluate how they want to invest and where they want to invest and what the company does. It's part of that. Could be part of that fundamental analysis people like to do in a company. Where's that money actually coming from? And could it or would it be affected by changes in currency? And does that company actually hedge the currency transaction? That's an interesting concept.
Exactly. Yeah. So here's a question for all of our traders out there. Everybody loves Apple, right, Stu? Very popular stock among our traders.
Yeah.
For all of you trading, does Apple have business overseas? I think that's probably pretty obvious, but is it a significant portion? What percentage does Apple have overseas? So think about that. And then do they hedge it? Do you know that? And it's something you should know before you even invest. So let's take a look. At the end of 2021, 67% of Apple's business came from overseas. Now, if you're looking for this for your companies, you can pull this up on the Edgar site, the SEC's site, on the 10K and the 10Q reports. 10K is the annual, and the 10Q is the quarterly. And it will show you in there any type of projected risks from currencies. But look at that, 67%. Now, here's a breakdown of it. Here's a breakdown of it. We have, I mean, you can see that, look at this, 24% in Europe, Greater China, 20%, Japan, 9%, rest of Asia Pacific, 8%. These are not small numbers. And you need to know that, especially if there are these companies that might be the ones that become a hot or maybe a meme stock, and people go, oh, I don't really know what they do, but everybody's talking about it. Let me jump Peloton. On it. Like Peloton. In fact, we got an
example. Peloton came out and said they don't hedge. They don't hedge the currency.
I've actually got an example of that, Stu, in here. Exactly. People don't realize that. They got a big...
You're going to be an investor. You got to know that.
You got to know that. So take a look at Apple. Now, good news is, for all of you who didn't know that, U.S. treasurers ramp up foreign exchange hedging as the dollar continues to strengthen. That was on Apple. And if you look at Apple, they hedge their risk. They don't hedge the demand for iPods or MacBooks. No. That's a risk they're willing to take. That's the business risk. And again, we find so many of our traders do exactly the opposite. So if they were running Apple, they would be doing that and trying to hedge the sales of MacBook Pros and trying to hedge the sales of AirPods that's not what you want to hedge. That's what your business is. Take those risks and then hedge everything else. So good news is that they do hedge. But Stu, you were just talking about this. Take a look at this. Peloton. This is right out of the 2022 annual report. Look at this. Accordingly, changes in the value of foreign currencies relative to the US dollar can affect our revenue and operating results.
Bill, I didn't even know you were going to pull that up.
I know. That's in the news. I said we was just talking about it.
This is in the news. You can read. Anybody can read this.
Right. But you got to know, most people don't.
But yeah, you have to know to think about reading it because it's part of the, it's part of the equation.
And so which quotes would you look? I mean, right here, manufacturing agreements provide fixed cost Taiwanese dollars, but provide for payment in US dollars based on the then current Taiwanese dollar to US dollar spot rate. This is exactly what we're talking about.
Just reading that.
Yeah. But the point is that if you're investing in these companies, that you have to realize, do they have exposure? How big is the exposure, and are they hedged? Because otherwise you can get some very nasty surprises when you buy the call option because you think the stock's going up, the stock goes up, and their earnings are down 20% below expectations. Why? Because of the foreign exchange rates that just adversely affected them. Although, Stu, what else could happen? We could get the reverse.
Go the other way. Go the other way, but that's not their business.
We've seen this where traders will go, how come they shattered earnings and the stock is, there's obviously a number of reasons that could happen, but one time it's the quality of the earnings. It might be that they got a lucky tailwind that pushed because of the exchange rate, and investors aren't going to reward them for that. They'll say, well, you got lucky. You can't repeat that.
Yeah, they might see the stock down and say, well, the earnings were up and the stock's
earnings were through the roof. They were up 20% higher than expected. Yeah, but it was because of favorable currency fluctuations.
Yeah.
And so again, you have to understand this stuff before you, especially for the longer term views. Now, if you're trying to be in and out in a day, you can probably skip it, or short term, 0 days to expiration options and things like that. But we're talking about your more serious money.
Investment.
More than investing.
If you look at Peloton, as I read through this, they have manufacturing agreements against Taiwan dollars, which is normal, but they don't hedge that. As I read it, it doesn't look like that. It's all spot deals, which you're at the risk of the market fluctuate. So it's just general market fluctuation risk,
right?
Which, I kind of see Peloton, but they're not doing that,
Right.
You think they're in the business of selling bikes, and they're actually in part of their business is trading Taiwanese dollars. I mean, it's insanity.
You would think. So now have Anthony, I'm assuming you've done things in Taiwanese dollars. You could just call one of your banks, BOFA banks, and
we can. I mean, essentially, we're at the core of what we do is we're buying a currency and selling a currency.
Right.
If we're basically someone says, hey, I want to move euro, right, to wherever, to Italy, as an example. In theory, we're buying their dollars in exchange for euro. That's in theory what we're doing. And we're delivering that euro to their destination account, the account they want us to deliver it to.
I see. So,
in theory, that's what Peloton's doing. Yeah. So that's what a spot deal is. That's not, you don't just sit on currency. You sit on currency and you deliver it where it needs to go. That's a typical business process.
Yeah.
So.
Yeah, it's very interesting to know that all this stuff that goes on behind the scenes, and yet some companies take polar opposite views about which risks to hedge. And so as an investor, you need to understand that this stuff happens.
Right.
It goes on at big levels. It goes down at law firms. That's why we have companies like with Anthony that will hedge this stuff.
Yeah.
And just like many of you, what we try to teach, you have to figure out what it is you're willing to take, which risks, which ones you don't want, how do you hedge those risks, and then take the ones that you do want. And that's a big part of trading right there, Stu.
And quantify it. You have to identify it, like Bill says, and you have to quantify it. Some people I have clients all the time. Oh, I have a $2 million portfolio. And what are you doing to hedge it? Well, I got this 10-lot put spread. Really?
Put spread. Exactly.
I mean, are you joking? Yeah. You got to be able to quantify what you're doing and see the results of the what if transaction that may occur down the line. Yeah. And that's part of your job. That's your job. It's fiduciary.
My account could go down 600,000 and my put spread's going to go up, $1,500 or $3,000 or something. You go, it's not a hedge.
Yeah. Well,
it's just not a hedge. They think just because they see the word put that it's a hedge. But like Stu says, you have to quantify it. How much is it going to move? And how much do you want hedged and how much are you willing to take? So anyway, those are just some things that we thought would be really interesting to share. I know Stu and I were talking about this. We said that would actually be a good coach's corner. Do you know anybody that knows anything about currencies? Stu said, I happen to know. And so we were very, very lucky. I said, you got to be kidding. You know somebody like this? He says, oh, yeah. So anyway, another favorite quote of ours from Nassim Taleb. He was the one who wrote Fooled by Randomness, a number of great books out there. But having an edge and surviving are two different things. The first requires the second. And I think that's a very profound quote. We hear all of our traders all the time talking about an edge, or I bought low vol and sold high vol, but then they don't realize that they are setting themselves up to potentially not survive because they're hedging the wrong.
Live to trade another day. Yep.
Live to trade another day. And one of the risks that you might be overlooking, in fact, I'm willing to bet that you are, is currency risks. So we hope that that would give you something to think about. At least look it up in the 10K, 10Q forms on, again, the SEC's Edgar base, and just see if your companies are exposed to foreign transactions. And for any of you who might have a business or law firms, give Anthony a call if it's something you'd like to hedge. So let's go back to chalk talk. All right, here we go. Apple has operations in Japan. Which of the following quotes would benefit Apple? Now, the exchange rate at the time was US dollar, Japanese yen, 135. So what did y'all come up with? Which of these would they like to see? So Anthony, if you could maybe give people a very quick description of what we're looking at here and what would they like to see?
Well, I just ran some small calculations here. If you're moving 10 million yen, for example, it would cost you around $80,000 of US to yen. We're at 125 versus 135 was $74,000. 145 was $68,000. So obviously, the further that, yen to dollar at 145 without question is the most affordable, for example. So,
but after the fact, they would like to, they want to see that fall, wouldn't they? So they could, when they repatriate the dollars.
Well, then it's the inverse, right? So
right. Yeah,
it would be, pulling yen in and converting them to dollars.
Yep.
You certainly would love to, at 125 is the rate you want, because obviously you're repatriating more, more dollars, obviously.
Right. Yeah.
So if you're, it depends on what you're doing. If you're pulling, if you're receiving yen in exchange for dollars, or if you're sending yen in exchange for dollars, it just is.
It's the other side.
It's the other side
exactly.
Of the
trade. It's just the other side of the trade.
Yeah. So something to look at for all the people out there. If you happen to see that maybe Peloton is exposed to Taiwanese dollars, you can pull these quotes up. And what this is telling you, the quote on the left is 1. So 1 US dollar equals 135 Japanese yen. So if you had $1, theoretically, you could walk to a bank, walk out with 135 yen. When you come back, you would divide it. You would take your 135 yen divided by, and you'd have your dollar back. But what if these numbers change?
So the way we look at it is that each yen is worth 0.0074. So it's under, it's
right.
It's two factors. It's off of it's. That's just the way we look at it. It makes life a lot more.
Oh yeah.
But there are two different ways of looking at it: is the whole or in decimal. So
yeah, you can look at it as the inverse, the reciprocal of that. So the thing is, if you had the 135 yen and you divided it by 125, you would have more dollars. And so those are just some basic things to look at as an investor. We just thought it would be something interesting to pass along because, again, it's one of the many hidden risks that traders just simply overlook. And those are some of the things that we like to help you with on Coach's Corner. And we thought that would help you. So, Stu, any closing comments?
As always, know your risk. Figure out what your risk is. Identify your risk, quantify your risk, figure out what risk you really are looking to take. Is it really a risk? And then live to trade another day. Just be cognizant of what you have and what can happen, so the market doesn't hand you something that you're really not interested in having.
Yep. Anthony, any final little pearls of wisdom or something from people about currencies?
Yeah, I mean, it's I'm gonna just just go off of what Stu said. Is absolutely just know your risk. I mean, just like I said earlier, you know, we deal with risk every single day of the week. It's built into our business. If you look at what we're doing, we just protect that risk through more information, more procedures in order to protect,
right.
The function of the business. Because we would, like Stu said, we've been at this for a long time, but we also want to trade another day. And, we don't want to be on the wrong side of any transaction, because it ends up costing you, a tremendous amount of money, especially
absolutely.
What was that, like years and years ago? Didn't Soros win? Like, what was that?
A $1 billion. Yeah, it was like in $90 billion. So 92 or something.
Soros wins $1 billion on a currency transaction
overnight.
Somebody else got hosed really bad.
Somebody else,
right? Whoever had the other side of that trade got beat. And if the other side wasn't kind of thinking about how they could lose, then they're, shame on them for not being a fiduciary to their account or their client's account, or being a prudent risk manager as opposed to a reward manager, which they're not. We have to be risk managers. Like Anthony. Anthony's a risk manager. That's what he does. He's trying
that's what we are as traders.
That's what we are as traders. We're all trying to mitigate risk and come out ahead. And
not profit managers. So anyway, with that, Anthony, I want to thank you again I know you were super busy this week and probably every single day.
Yeah, I appreciate your patience.
A huge meeting today, and hopped off of like a 5-hour meeting to join us. It is so greatly appreciated. I know that our traders appreciated it as well.
Yep.
So thanks for sharing your decades of amazing experience. I hope everybody learned something. Hopefully we'll have you back in the future, and we'll look for you next Thursday on Coach's Corner. Thanks so much, everyone.
Thanks, guys.
Thanks, everyone.
Take care. I'll see you guys.
All right. Thanks, Anthony.
Okay.